Chapter 4. We obtain after-tax cash flow using information from income statement. After-tax cash flow is obtained by earnings after taxes plus non-cash charges, which include depreciation and deferred taxes. Depreciation represents systematic allocation of the cost of an asset over a specified period of time. Deferred taxes represents tax amount reported to stockholders minus tax amount actually paid. The reason we add those cash flows back is that those cash flows are subtracted in accordance with accounting reporting to obtain earnings after taxes reported in the income statement. However, those cash flows are not actually spent over the period when the income statement is prepared. Those cash flows are still retained in the company for use. This slide illustrates how to obtain after-tax cash flow using information from the income statement. We first obtain earnings after taxes from the income statement. We then add back depreciation reported in the income statement and deferred taxes obtained by calculating the difference between the tax amount reported in the income statement and the tax amount actually paid. A firm definitely wants to plan first to make sure it has sufficient funds to support its ongoing operation. To do so, a firm needs to perform forecasts. In the following, we will discuss the percentage of sales forecasting method. To use the percentage of sales forecasting method, we forecast the amount of financing needed for a given increase on sales. The percentage of sales forecasting method is useful in preparing pro forma financial statements and in estimating future funds needed. There are two crucial assumptions made in the percentage of sales forecasting method, which are present asset levels are optimal with respect to present sales, implying any increases in sales will lead to increases in asset investment. Most items on the balance sheet increase in proportion to sales increases. The percentage of sales forecasting method assumes as the company's sales increase, its assets will increase proportionately to support the new sales. In addition, the current liabilities that vary directly with sales, that is, accounts payable, will also increase proportionately to support the new sales. The difference between the forecasted asset increase and the forecasted current liability increase is equal to the total financing needed. The relationship can be expressed in the equation form shown here. There are two sources of funds to support the total financing needed by the firm, which are funds generated internally and obtained externally. Funds generated internally are from increased retained earnings, which are calculated by the difference between forecasted earnings after taxes and dividends paid. The additional financing needed obtained externally is obtained by subtracting the increased retained earnings from the total financing needed. Let us work on a problem to illustrate how to obtain the additional financing needed using the percentage of sales forecasting method. First, Write down the formula of the additional financing needed when using the percentage of sales forecasting method. Second, obtain the information needed to use the formula from the problem. The earnings after taxes are obtained by the difference between the forecasted sales and the forecasted expenses, including interest and taxes. The forecasted sales are obtained by the original sales plus the increase in sales. The forecasted expenses are calculated by the original expenses plus the increase in the expenses. Third, plug the corresponding numbers into the formula. We can then obtain the additional financing needed. In the following 2 slides, we illustrate how to prepare pro forma balance sheet and income statement. We obtain the pro forma balance sheet by using the information from historical balance sheet. We first adjust numbers which change proportionately with sales changes. They are calculated by original numbers times 1 plus percentage increase in sales. The percentage increase in sales is calculated by the increase in sales divided by the original sales. Notes payable is calculated by original number plus the additional financing needed calculated from the earlier slide. Long-term debt stays the same as assumed. Stockholders' equity is obtained by original equity plus the increased retained earnings obtained in the earlier slide. We obtain the pro forma income statement by using the information from historical income statement. Sales are obtained by the original sales plus the increase in sales. Expenses are obtained by the original expenses plus the increase in expenses. Dividends are given in the problem. Another practice problem of obtaining the additional financing needed using the percentage of sales forecasting method. The only difference is that the company has excess fixed assets and no increase in net fixed assets is required as sales are increased. We solve the problem exactly the same as illustrated in the problem 3C. The only difference is that fixed assets do not adjust proportionately with changes in sales because it's not operated at full capacity.